everybody, I'm Mike DeSepoli. Welcome back to the Ask the Advisor show, brought to you by Heritage Financial Advisory Group. So with volatility on the rise in the markets, we want to spend a little bit of time today on behavioral finance. And by that I mean, how does your behaviors impact the long-term probability of success in your investment programs? And there's a lot of research and studies that have been done around this topic to try to get down to the nitty-gritty about how our emotions and our behaviors at times can guide and even misguide our decision-making process. So what I want to talk about today is how your brain reacts to a crashing stock market. Because if we know more about it, we might be able to do better the next time around when we're put in this situation. So, it's important to understand that when the market crashes and your portfolio takes a beating, so too does your brain. We're absorbing a lot of stress from the markets, and we all compose it and disperse of it in different ways. And ultimately, what stress does is it wreaks havoc on your brain, and it makes us less of who we are as people. It takes a lot of work to keep yourself from panicking when the market is moving against you. And it's very important in times like that not to lay waste to all of your long-term goals that you've set for yourself. Now, when we talk about stress making investors less of who they are, what it does essentially is it causes us to fall back on simpler methods of thinking. It decreases our ability to draw on knowledge from previous experiences that we might have had that would help guide us through some of these turbulent times. So it strips out all of that knowledge that we have. It doesn't totally dispose of it, but it makes it hard for us to channel it to make better decisions. Now, the particular type of stress that we're talking about here when markets crash is what we call acute stress, okay? And acute stress actually affects the prefrontal cortex of the brain. This is the area of the brain that is responsible for long-term thinking and planning. And naturally, when we're talking about investing, everything is beneficial to have a longer-term focus on these things. So when you're talking about stress, that's going to directly affect the part of our brain that we use for long-term planning. It's no wonder that investors consistently make bad emotional decisions inside of their portfolio. This type of stress also leads to what we call tunnel vision, because it makes it very difficult for us to draw on previous knowledge and evaluate choices that are in front of us. Instead, we become very narrow, laser focused. And in turn, by doing that, we make worse decisions because we're not considering a full array of choices that are against us. This type of stress is also that feeling that you get when you just can't look away from something bad. Maybe you're watching the markets crash on TV, you just can't look away, and you stop noticing good things that are going on around you because all you can do is focus with a narrow focus on the one singular event that's going on in front of you. Now, taking it a step further, when our threat sensitivity rises, right, this fight or flight notion that people feel, when our threat sensitivity rises, we have a bias towards bad news. We tend to believe that every outcome will be a negative outcome because we're stuck in a negative feedback loop. Even further than that, when we're in this survival mode, as we would call it, we start to value the opinions of what other people are doing more than what we actually believe ourselves. And this is what we call the herd mentality. And if you know anything about investing, the herd mentality is one of the most dangerous things there is. People convince themselves because a lot of other people are doing something that is the right thing to do. And unfortunately, investing the herd, the majority of people are usually on the wrong side. So following the herd when it comes to your portfolio can be something that is very costly. And also, stress affects our working memory. And when it affects our working memory, it narrows our choices that we have in front of us, which leads us to believe that there's less viable options for us to pursue than there actually may be. And it also impairs our ability to be flexible, to think nimbly, to digest the data as it comes at us, and to make sound decisions. So as you can see, we always knew that market crashes were stressful, but there is a science behind it in terms of how it affects you, your brain, and in turn your decision making. So we lay this out for you today because what we understand better, we have the ability to impact as we move ahead. So there's a couple different ways that you can avoid feeling this level of stress and in turn making bad investment decisions. Number one, shameless plug here, work with a professional, right? They'll keep you grounded, they'll keep you focused on your longer term goals and objectives, and they will do the worrying for you so you don't have to do it. Number two would be know what you own. It is very important that you understand the investments that you own and you know how they will behave. There's a lot of investors in the market right now that are waking up today realizing that they own companies in the oil sector, which is a terribly hard to hit area right now in the economy. So it's very important to know what you own and manage the level of risk that you are comfortable taking. Revisit that once a year. Make sure the portfolio that you have from last year suits your goals for this year and then some, and continually revisit that process each and every year. If you have any questions about anything that we talked about here today, about how to better manage stress, personally and in your financial investments, please reach out to us. We're always happy to talk with you and make sure that investors are doing the right thing and the sound thing with their money. Thank you so much for tuning in, and we will see you back next week.